Hey folks, how you doing today? My name is Rob, and in this video, we're going to talk about how does a index universal life policy work. That's probably what you Googled or put in YouTube, and that's what I want to discuss today. I've been doing this for about 25 years now. I've been licensed since 1998, and you can look up my national producer number below in the description so that you know that I'm an actual licensed agent, and I kind of know what I'm talking about. So anyway, really, just to kind of backtrack real quick, there's three types of life insurance. You've got term life, whole life, and universal life. And as a variant of UL, you have index universal life. And term life is just how it sounds. You rent it for a time period, whether it be 10, 20, 30, even 40 years. You can do that for term. And at the end of the term, you then can either end it or convert to a whole life insurance policy at a much higher rate and at a much lower face amount. Okay, so just so that you understand that. There is some neat features of term. There's critical illness riders you can add on to it. Some policies offer that. And then another neat feature is you can add on return of premium. Only a couple of companies offer it. I have access to them throughout the United States and here in Connecticut. So, with that being said, return of premium is just like it sounds. After 20 years, let's say you have that 20-year term policy, you get back all the money that you put in, minus any surcharges that the insurance company may have. They're probably minor, so every company is different. And again, there's only a handful that actually do offer a true return of premium. Next, let's talk about whole life insurance. Whole life is just like it sounds. Whole life, you pay the premiums your whole life. It can build significant cash value, and it's cash value that you can borrow against, which is kind of neat. Let's say you have to do a driveway over or a new roof. Driveways can be like 10,000 now. I know a friend of mine does driveways, and he's like, yeah, they're 6 to 10 grand. It's not, and these are not huge driveways either. And roofs are through the roof, no pun intended. Uh, 15, 20, $30,000 to replace a roof. So if you need that in an emergency, that money could be there and could come in handy. But let's talk about universal life. Universal life has been around since index universal life, I should say, has been around since 1997. UL has been around prior to that. And UL is just a hybrid of term life and whole life. Kind of encapsulates the best of both worlds. So it builds cash value. As far as face amount wise, uh, as far as if we're talking, let's say you put in $100 a month into each policy or whatever. Term life is face amount is going to be up here. Then you've got UL or IUL will be right around here, and then you've got whole life, which will be down here. Just because whole life, it's just the fact that it's building cash value and other things, and it's an old fashioned type of product or policy. UL is the new kid on the block, if you will. But they're tried and true. I think IUL, and UL are going to be the wave of the future if they're not already. Term is always going to be there, but IUL, what it does is Universal Life and IUL, they both build cash value. And the difference is, though, IUL adds, for lack of a better term, an investment component into the life insurance. So it's indexed against the most popular is the S&P 500. That's the most popular market out there. You have the Nikkei, you have others, but most life insurance companies based in the U.S. base it on the S&P 500. And how it kind of works, and I don't want to get too into it in this video because I'll be here for another hour and a half. And being St. Patrick's Day that I'm filming this, you probably have some other cool stuff to do, right? So that being said, it's indexed against the S&P. Okay, you use that as an example. The better the S&P does, the more your life insurance, your index, UL performs. In other words, potentially your cash value could be much more than a whole life policy ever would be, which is kind of cool. And a lot of people use an IUL as a supplement for their retirement income. There's a lot of books out there, Infinite Banking or Be Your Own Bank, where they try to um, convince you that IUL is the way to go for retirement, put all your, eggs in one basket. Never do that, right? That's why there's that saying. Um, there's a lot of insurance brokers out there that try to say, hey, put everything into IUL, yada, yada, yada. Don't do that. Run as far away and as fast as you can. Because all it is, IUL is just another strategy for retirement to add to your 401k, your IRA, your pension, Social Security. What it is in a nutshell is IUL, you can take out a policy loan. You don't want to take out withdrawals because if you start taking withdrawals, you can pay taxes on that. With IUL, the loan is something that you don't have to pay back as long as you keep the policy in force, and you're not going to be pay taxes on the interest that you earned, um, being that it was indexed against the S&P. So if that's clear as mud, so be it. That's why I have my website, which will explain it a lot better. I'll put that link down below. And the thing is, you want to schedule a consultation with somebody like me that has experience in it. I don't want to call myself an expert because nobody's an actual expert in anything. I've heard even some of the gurus make huge mistakes. Thinking of one individual in particular, she's very popular, and she gave some bad advice about long-term care insurance. I'll never forget that, telling somebody to put off getting it. And I'm like, every year that you put off getting it, it gets more expensive. And that's same with IUL. A lot of times, the most popular thing I hear about is, or I don't want to say excuse or rebuttal or whatever, but is I want to think about it. Well, guess what? Every year you think about something, the premium goes up. It's never be more affordable than it is today. And more importantly, I get the call. Whenever I get the call, hey, I want to enroll. I'm like, what happened? It's like, well, I just got diagnosed with cancer, or I just did this, and I'm like, hey, I'm sorry, but you can't get this. Now you have to go to a like a graded policy. It's a deferred benefit. So if you're in good health and you have the money, there's nothing to think about. Okay, you look at it, you get educated upon it, and then within a week's time, you make a decision. Because if after a week goes by, you're not going to do it. I'm just telling you right now. I'm being realistic. I'm not. I don't do hard sells. That's not me. I'd never make it in the car or auto sales business, if you will. Not to put those people down either. Um, but yeah. So anyway, with that being said, um, that's it, folks. I'm done talking. Hopefully, you're done listening. And my goal was that we finish at the same time. And my career as a comedian went nowhere. So, that being said, take care, folks. Have a good day. And, give me a call, text me. I'll put all my info, contact info, email at the bottom. And if you have questions, you don't have to necessarily call me right away, but texting I prefer because I can get right back to you. Whether I'm in, waiting to get into a meeting or waiting to get out, whatever. So, thanks so much for listening to me and giving me the opportunity to share some thoughts with you. That's it. So, take care, folks. Have a good day.